Hello friends, I welcome you to a lecture on Indas16 Property, Plant and Equipment. So in this lecture we are going to discuss about Indian Accounting Standard 16, which deals with property, plant and equipment. This standard covers tangible fixed assets. Okay. So earlier the same standard was covered by Accounting Standard 10 fixed assets and AS6 covered depreciation. But the scope of Indas16 is it covers not only accounting for fixed assets in our books but also how to calculate depreciation and how to calculate the WDV of an asset, recognition, derecognition, depreciation, all the aspects relating to fixed assets are covered in one standard called as Indas16. Okay, so our agenda for this lecture is to discuss Indas16, and specifically in this part I am going to first of all discuss what is a property, plant and equipment. Then we are going to discuss about what is covered by the standard, what is not covered by the standard. Then we will discuss about initial recognition, that is when for the first time the tangible fixed asset, property, plant and equipment is recognized in our books. At what value should it be recognized? That is the cost model. So this is what we are going to learn in this part. I am going to discuss this standard in various parts. In the first part we are going to discuss only about what is property, plant and equipment. We are going to discuss about what is covered by the standard, what is not covered by the standard. Then we are also going to discuss about how initially property, plant and equipment is recognized in our books of account. So let us get started. The first thing we are going to discuss is objective of the standard. So what is the objective of this standard, Indas16 property, plant and equipment? The objective of the standard is to prescribe accounting treatment for property, plant and equipment. So when we purchase property, plant and equipment, how to initially recognize it in our books of account, how to account that property, plant and equipment in our books of account is the objective of the standard. So to prescribe accounting treatment for PPE is the objective of the standard. Then we come to the principal issues. What are the various issues we are going to face in the standard? We are going to learn various issues. The first issue which we are going to learn is when can I recognize an item of property, plant and equipment in my books of account as an asset? So when can I capitalize an expenditure on PPE as an asset in my books of account? So when can I recognize an asset in my books of account? When can I record an asset in my books of account is the first question I am going to handle. The second question which this standard is going to handle is at what value are you going to initially recognize it? That means when I acquire property, plant and equipment, when I acquire an item of tangible fixed asset, at what value will I record it in my books of account initially? On balance sheet date, if the property, plant and equipment has not been disposed, it has not been sold, at what value will I carry it my balance sheet? Determination of the carrying amount subsequent to initial recognition. How am I going to do it? That is what I am going to discuss in the standard. So three issues. When can I recognize plant and equipment? At what amount to recognize it initially? Subsequently, at what value to carry it in my balance sheet? And the next issue is how to deal with depreciation. Now, the issue relating to impairment is covered by another standard, Indas36. So this standard is not going to discuss about how to deal with impairment losses, that is within the scope of another standard. So this is the principal issues which are covered by the standard. Next we come to the scope paragraph. Now, as per the standard, certain items or certain assets, even though they may satisfy the definition of a property, plant and equipment, are outside the scope of this standard. Okay. Before I go into the scope standard, we can just have a rough idea about property, plant and equipment. What is an item of property, plant and equipment? As per the standard, it is a tangible item which is held for use in production or supply of goods or services, or held for giving it on rent to others, or for administrative purposes. So this is the definition of PPE contained in the standard. It is a tangible item which is held for use in production of goods or provision of services, or supply of goods or supply of services, or for giving it on rent to others, or for administrative purposes, and which has an expected useful life of more than 1 year. So generally we are talking about assets which can be used in the production process, which can be used to supply goods, which can be used to provide services to others, or which can be used for administrative purposes. Computers, typewriters, they are used for administrative purposes. Apart from that, we can also give the assets on rent to others. If you have a vehicle, you can give it on rent to others. If you have a building, you can give it on rent to others. So for administrative purposes or for giving it on rent to others. And these tangible items have a period of life of more than 1 year. Such items of we can say tangible fixed assets are called as property, plant and equipment. So this is the definition of PPE. But certain items are not covered in the standard. The first item is asset held for sale. Now, what is asset held for sale? This is specifically covered by Indas 105. Now, as per Indas 105, what is an asset held for sale? It is an asset whose carrying amount is principally going to be recovered through sale. That means there is an asset, it may be a machinery, it may be an equipment, or it may be a building which I am using for my business purpose, and the management has decided to recover the carrying amount principally by selling it. That means whatever cost I have incurred or whatever is the book value right now, I want to recover it by selling it, not by using it. So such assets are called as assets held for sale. Now, when can you, we can say, classify an asset as an asset held for sale? Management has taken a decision to dispose of an asset. The management is committed to the sale. The asset is in the condition ready for sale. That means we need not do anything for getting the asset sold. In its current condition, asset can be sold. Apart from that, the management is actively marketing the asset for getting it sold at a price which is reasonable when compared to the fair value. That means the management is not expecting an extraordinarily high price. So whatever is the fair value of the asset, so we can say at a price which is reasonable when compared to fair value, at that price the management is trying to dispose of the asset. And the standard says there is a time limit of 12 months. So once the decision has been taken, it should be disposed of within a period of 12 months. So once the asset satisfies the definition of an asset held for sale under Indas 105, its measurement requirement is not within the scope of this standard. So how to measure those assets in our books of account? As per Indas 105, those assets have to be carried in our books at lower of carrying amount or fair value less cost to sell. So we have to compare what is the carrying amount, WDV in our books right now, fair value less cost to sell, whichever is lower. At that value we are going to carry these assets in our books of account. Depreciation would cease. That means the day asset is classified as asset held for sale, on that date depreciation should cease. That means the company should stop charging depreciation. So how to measure these assets for books purpose is covered by Indas 105. It is not covered by the standard. Okay. Now come to the next item. Biological assets relating to agricultural activity. So if you are doing any agricultural activity, and in that agricultural activity you have certain biological assets. Biological asset can be a living animal, it can be a plant. So if you are having animals as part of your agricultural activity, if you are having some living plants as a part of your agricultural activity, those biological assets are outside the scope of Indas 16. Example, if you have a dairy farm, the buffaloes are biological assets for the dairy farm. You have a sheep farm, those sheep are biological assets for the sheep farm. But the buffaloes and sheep are outside the scope of the standard. But there is an exception here. The exception is bearer plants. Now what is a bearer plant? Suppose you are an apple farmer or you have a vineyard. Now apple farmer, he will have a big farm in which he would plant apple trees, and the day the apple trees mature, they will start giving you some produce, the apple fruit. Now these apple trees are capable of generating produce, generating we can say apple for a period of more than a year. Or you have a mango farm. Now you have mango trees. These mango trees can give you mango fruit for a period of more than 1 year. So these are living plants which can bear produce for a period of more than 1 year. So such living plants are called as bearer plants. Accounting for bearer plants, even though bearer plants are used for agricultural activity, apple farming is agricultural activity, mango farming is agricultural activity, but still the accounting for those mango trees, apple trees is covered by Indas 16. Okay, so even though biological assets relating to agriculture activity have been scoped out, they are covered by Indas 41, but out of those biological assets, a specific asset called as bare plant is still covered by the standard. Okay, now let us come to the next exclusion, exploration and evaluation expenditure. A company is engaged in iron ore mining, coal mining, or they are involved in the business of extraction of gas, oil, etc. So in such cases, the expenditure incurred by them between two dates, I will give you two dates. So there is a coal mining company, they have acquired right to explore on a particular date. So let us say this is the date on which a coal mining company has acquired right to explore from the government in a particular land area. Okay, and this is the date on which technical and commercial feasibility has been established. See, you just don't go to any place and you start digging for coal and oil. So what you have to do is, first of all, you have to apply to the government to acquire rights to search for coal, gas, oil, etc. Once you get the right, the government will tell you in which area you can search. So once you acquire the right, you go and start searching. And during the searching process, you may do some drilling activity. You will do some geological studies, chemical studies. You will do some trenching activities. This all is scientific activity aimed at exploring. You want to search for oil, you want to search for coal, you want to search for gas. Now, the objective of this activity is to determine whether technically it is possible to take out coal. You want to know how much coal deposit is there in that area and whether it is technically possible to remove that coal. And then commercial viability. Is it commercially feasible? Will it make us a profit if I extract coal from this area? So to demonstrate technical possibility and commercial viability, the coal mining company will carry out this exploration and evaluation activities. So exploration and evaluation activities are aimed at searching for deposits of coal, oil, gas. Apart from that, they also have to determine technical feasibility and commercial viability of extracting coal. So the expenditure incurred by such companies between these two dates, the date on which they acquire right to explore and the date on which technical and commercial viability is demonstrated, between these dates, whatever expenditure is incurred is called as exploration and evaluation expenditure. Treatment, accounting treatment for such expenditure is covered by Indas 106. It is not covered by this standard. Okay. Now let us come to the next point. Mineral rights, mineral reserves. Suppose a mining company has a right to do mining in a particular area, or they are sitting on a huge coal reserve, or they have identified that the government has given them right to extract crude oil from a particular area and they are sitting on a huge reserve. So these rights, these reserves are outside the scope of this standard. Okay, so this is the scope exclusion as per the standard. Now we come to the next part. PPE used to develop B2D covered. What does that mean? If you are using any machinery in your agricultural activity, if you are using any equipment in your exploration and evaluation activity, if you are using any machinery, excavation machinery, truck, etc. in your mine, etc. So all these equipment which is used in these three activities will definitely be covered by the standard. Okay. But agricultural activity, biological assets are not covered. If you use any machinery, equipment in these activities, definitely they will be considered as part of within the scope of this standard. Okay. Now let us go to the next issue. Assets taken on finance lease. Suppose you have taken an machinery on finance lease. You are not capable of purchasing the asset for cash. You have purchased the asset on an installment system which is called as assets taken on finance lease. Now in this case, the initial recognition, see, as per Indas 17, when a lessee takes an asset on finance lease, or as per old AS 19, when a lessee takes an asset on a finance lease, he has to recognize the asset in his books at lower of fair value of the asset or present value of minimum lease payments, whichever is lower. So at what value to recognize such assets initially in the books of the lessee is outside the scope of Ind AS 16, it is within the scope of Ind AS 17. So as per Ind AS 17, if you have taken an asset on finance lease, initially you have to recognize it at a value decided by Ind AS 17, not by Ind AS 16, that is fair value of the asset or present value of minimum lease payments, whichever is lower. But the other items, the other treatment, let us say componentization, repairs and maintenance, depreciation, all these aspects of accounting relating to that asset are still covered by Ind AS 16. So initial recognition measurement purpose we would have to refer to Ind AS 17, but the other aspects relating to componentization, repairs and maintenance, depreciation, all those aspects of accounting related to that asset are still covered by Ind AS 106. So there is a limited scoping out. Okay. Now we come to the next item. Land and building held as investment property. Now first of all, what is the meaning of investment property? Investment property is land and building which is held for earning income by way of rent, or they are held for capital appreciation, and they are not held for sale in the ordinary course of business. It also includes land whose use is not yet determined. So land and building which is principally held for earning income by way of rent or we are holding land so that in future the land value will increase and I'll get some capital appreciation. Or land which has undetermined use. Right now I have not determined for what purpose I am going to use the land for. Such assets are considered as investment properties. These are not used in the activity of production of goods, provision of services, so they are not considered as part of property, plant and equipment. So Ind AS 40 deals with investment property. Now as per Ind AS 40, such land and building which are held not for sale in the ordinary course of business but which are held for earning income by way of rent or for capital appreciation purposes, such assets should be carried in our books using the cost model. Now what is cost model? Cost model is the model prescribed under para 30 of Ind AS 16. So this standard defines what is a cost model. So land and building which are held as investment property, these are not part of property, plant and equipment. They do not satisfy the definition of property, plant and equipment. Even though they do not satisfy the definition of property, plant and equipment, they have to be carried in our books using the cost model, and cost model is prescribed by Ind AS 16. Okay, so this is what is scope in and scope out as per the standard. Now let us come to the definitions part. Even before I go to the definitions and other aspects, let us first start with initial recognition. Now I think by now you would have understood what is property, plant and equipment. I will define property, plant and equipment once again for you. Property, plant and equipment is a tangible item which is used in production of goods or for provision of services, or they are held for giving it on rent to others or for administrative purposes. That means these are machinery, equipment which we use for conversion of goods into conversion of raw material into finished goods. Computers which are used for administrative purposes, or equipment, vehicles which we are going to give it on rent to others. So these are used in our business activity. Now if you are having land and building which I am holding for giving it on rent to others, not utilized in production of goods, provision of services, not used for administrative purposes, such land and building will be investment property. They will not be property, plant and equipment. So now if you understand what is property, plant and equipment, when I acquire property, plant and equipment, at what value should I recognize in my books is the question first of all. So when I purchase an item of property, plant and equipment, at what value should I recognize it in my books of account? So let us discuss it. Initial recognition is at cost. That means I have to recognize it at cost in my books. What is cost? It is the amount of cash paid to acquire the asset, or it is the fair value of the consideration paid to acquire an asset. So you may pay cash or you may pay other consideration. The other consideration measured at its fair value will be considered as cost. So whatever incurred out of my pocket to acquire the asset will be considered as cost. Now what will be included in cost? Purchase price, add import duties, that means customs duties, etc. Non-refundable duties and taxes. Any other tax which has been levied when you are purchasing the asset but which are not refundable. That means you are not going to give it back, you are not going to get the tax back in subsequently. Such taxes can be added. Directly attributable cost, any cost which is incurred to bring the asset to the present location and condition in which I want to use this asset. So all expenditure incurred to bring it to the we can say present condition and situation where I can start using it for my intended purpose, all such costs can be included. Apart from that, we have to make an initial estimate of what will be the dismantling cost, restoration cost. Suppose if you are installing equipment which is harming the environment, so in such a case your environmental loss or pollution control loss may require you to dismantle the asset once it reaches the end of its useful life and restore the environment where it was installed earlier. So I have to initially estimate what would be the cost of dismantling and restoring the environment once the asset reaches the end of its useful life, and that cost also should be added to the cost of the asset. Okay, so this is something which is new, which was not there in our earlier standard. Okay, now we come to a discussion on what is directly attributable costs, costs which are incurred to bring asset to present location and condition. Employee cost. So whatever costs we have incurred on employees who have contributed in bringing the asset to the present location and condition, such wages, salaries can be included. Site preparation. So whatever costs have incurred for preparing the site where the equipment will be installed has to be capitalized. Delivery and handling charges, installation expenses, cost of testing. Now, before we start utilizing the equipment for commercial production, we would do some test production. We will do production on a test basis. Now, we want to know whether the equipment is functioning properly or not. Now, during this testing phase, if some output is achieved, the sale value of this output is subtracted from the cost of the equipment. So, cost of testing we will add, but the sale price of the production which has been produced during the testing phase, that income will be subtracted from the cost of the asset. Then we come to professional fees. If we have involved certain professionals who are helping us in the installation activity, and if we have paid any fees to them, that fees can also be added to the cost of the asset. So this is what will be included as part of cost of the asset. Now, there are certain costs which are not going to be included as part of cost of the asset. Cost of opening a new facility. You are opening a new distribution center, you are opening a new retail center at a different location. Cost of opening it will not be capitalized. Introducing a new product. A company is launching a new product and it is incurring heavy advertisement expenditure, etc. Such expense will not be capitalized. Next, cost of conducting business in a new location. You have started doing business in a new location and you are incurring advertisement, promotion expenditure to do business in that new location. In such case also we are not going to add such costs. Administration overheads. If the administration activity has not contributed in bringing the asset to its present location and condition, such administration overheads are also not going to be included within the cost of production, within the cost at which the asset has to be incorporated in our books of accounts. So there are certain items which are not going to be included. Now we come to self-constructed asset. Now let us suppose I have not purchased an asset. I have not acquired an asset. I have constructed my asset. I am constructing my own building. I am constructing my own machinery. I am manufacturing my own machinery. So in such cases, what would be cost for the self-constructed building? What would be cost for the self-constructed machinery is the question. As per the standard, whatever is the cost of production of this building, what is the cost of production of the machinery will be considered as cost. But certain points you have to keep in mind. Material consumed for construction of the building can be added. Labor cost incurred for construction of the building can be added. If you are incurring some overhead which are directly attributable to construction activity, they can be added. The other important points are, we have to eliminate any internal profits. Let us take an example. There is a real estate company or a construction company which is constructing its own head office. They are constructing their own head office. They know that if they construct a similar building for others, they will get some profits. Just because you will get profits by constructing a similar building for others, you are not going to include such profits as part of cost of construction of the building. Opportunity cost cannot be included. Next, abnormal losses. If any abnormal amounts of material, labor costs, overheads have been wasted during the construction process, such items cannot be considered as part of cost. Okay. Then borrowing cost can be capitalized. Indas 23 deals with capitalization of borrowing costs. If you have incurred any borrowing costs during the construction of the asset, such borrowing costs can be added to the cost of the asset if it is permitted by Indas 23. So this is how you arrive at cost for self-constructed assets. Okay. So we have covered initial recognition costs which are not included, then we have covered self-constructed assets. Now let us come to the